Somewhere between your last paycheck and your next bill, there's a gap. And right now, that gap is widening for anyone operating on a single income source. Today, we fix that. 7 specific assets, consistent monthly income, this current environment, tariffs, elevated rates, shifting supply chains. This is not a theoretical conversation. This is a diagnostic briefing. By the end of this video, you'll know which assets deserve your attention, which carry hidden risk most people are ignoring, and how to build a monthly income structure that doesn't collapse when the macro shifts. But before we touch a single asset, one foundational concept. Monthly income is not about finding the highest yield. It is about finding the most durable yield. Anyone can chase 12%. Very few can hold through a volatile quarter and still collect. We are not building a get-rich structure. We are building a get-paid reliably structure. That distinction will save you more than any single investment tip ever could. Think about that. Let's get into it. Asset number 1. Short-duration Treasuries and Treasury money market funds. I know what some of you are thinking. Treasuries are boring. You are right. They are beautifully, strategically boring. And in this environment, boring is producing real returns. With rates still elevated, short-duration government instruments, meaning 3-month, 6-month, and 1-year Treasury bills, are still generating yields that would have seemed remarkable 5 years ago. Treasury money market funds specifically allow you to access these yields with daily liquidity. You are not locked in. You are not exposed to credit risk, and you are collecting income every single month. Here is the strategic point. In a high-tariff, potentially slowing growth environment, having a portion of your income-producing assets in the safest possible instrument is not just conservative, it is intelligent positioning. If the economy softens and the Fed moves to cut rates more aggressively, you will need to redeploy this capital. But right now, while these yields exist, you collect. Simple, clean, durable. That is the entire playbook for Asset 1. Asset number 2. Dividend-paying domestic industrial and infrastructure stocks. This is where the Trump economic agenda and income investing intersect most directly. The reshoring of manufacturing, the tariff protection of domestic producers, the infrastructure spending that has continued across administrations, all of this creates a tailwind for companies that build things, move things, and power things inside the United States. Now, I want to be precise here because this is not a blanket recommendation to buy all domestic industrials. You are looking specifically for companies with a long track record of not just paying dividends, but growing them. Dividend growth is the metric, not just current yield. Because a company that has grown its dividend for 15 or 20 consecutive years has demonstrated something about its business model, its management discipline, and its ability to generate cash across multiple economic cycles. In the current environment, companies that benefit from domestic production incentives and infrastructure investment are being handed a structural advantage. That advantage translates into earnings. Those earnings support and grow dividends. And those dividends become your monthly income when you build a portfolio spread across companies with different payment schedules. Let me be direct about that. Dividend investing done correctly is not passive. It requires you to understand what you own and why. But once you have built that foundation, the income becomes remarkably consistent. Asset number 3, real estate investment trusts, specifically in non-traditional sectors. REITs have had a complicated few years because of interest rates. When rates rise, REIT valuations get compressed because investors can access income from safer instruments. That creates buying opportunities in quality REITs for income investors who understand what they are doing. But here is the nuance. Not all REITs are created equal in this economy. Traditional office REITs are structurally challenged by remote work patterns. Some retail REITs are under pressure from e-commerce. The opportunity right now is in what I call the infrastructure of the new economy. data center REITs that support the artificial intelligence build-out, industrial and logistics REITs that benefit from domestic warehousing demand driven by reshoring and tariff-driven inventory management changes, and certain healthcare REITs that serve an aging population demographic that is completely indifferent to tariff policy. These sectors are generating consistent funds from operations, which is the metric you use to evaluate REIT health, not traditional earnings. And they are paying monthly or quarterly distributions that, for the right investor, represent genuine portfolio income. Stop for a moment. Are you currently invested in any income-producing assets, or are you still entirely dependent on a paycheck or a single income source? One word. Drop it below. Invested or paycheck? I read every comment. Asset number 4, high-quality corporate bonds and bond ladder strategies. I want to address something that a lot of investors in the 35 to 55 age range are confused about right now. The bond market feels complicated. The yield curve has been doing unusual things. The news coverage of Treasury auctions and deficit concerns has been unsettling. I understand the confusion, but let me simplify this. A bond ladder is one of the most reliable income structures ever designed. Here is how it works. You purchase bonds with staggered maturity dates, some maturing in 1 year, some in 2 years, some in 3, some in 5. When each bond matures, you collect your principal back along with all the interest payments you received along the way. Then you reinvest that principal at whatever the current rate environment offers. This structure does 2 things simultaneously. It gives you regular income from the interest payments, and it gives you regular liquidity events where your capital is returned and can be redeployed. In a period of rate uncertainty, this is extraordinarily valuable. You are never fully locked in. You are never fully exposed to rate movement in one direction. For this strategy, I recommend focusing on investment-grade corporate bonds from companies in sectors that benefit from the current economic agenda. Domestic manufacturers, energy producers, infrastructure companies, not because of ideological alignment, but because the policy environment is creating earnings support for those sectors, and earnings support means bond covenants are more likely to be honored. That is the trap many investors fall into. They chase yield in corporate bonds without understanding what is actually backing that yield. A 10% yield on a corporate bond from a financially stressed company in a sector facing headwinds is not income. It is a countdown timer. Asset number 5, covered call option strategies on existing stock holdings. Now I want to address something directly. This asset category sounds complex to people who have not used it. I'm going to demystify it in about 90 seconds. If you already own shares of a stock, a dividend-paying domestic company, for example, you have the ability to sell someone else the right to buy your shares at a higher price in the future. In exchange for selling that right, they pay you a premium today. That premium is your income. You collect it immediately. It is yours regardless of what happens next. This strategy, called a covered call, allows you to generate additional monthly income from assets you already hold. In a sideways or moderately growing market, which is plausible in the current environment given the uncertainty around trade negotiations and global economic conditions, covered calls can significantly enhance your total income without requiring you to sell your underlying positions or take on new risk. Think about that. You are being paid to agree to potentially sell something at a price higher than it trades today. If the stock never reaches that price, you keep the premium and keep the stock. If it does reach that price, you sell at a profit and collect the premium. The only scenario where this hurts you is if the stock makes a massive unexpected move upward and you miss out on gains above your strike price. For an income investor, that is a very acceptable trade. This is not day trading. This is not speculation. This is systematic income generation from assets you already believe in enough to hold. Asset number 6, private credit and business development companies. My friend, this is the one that most people in your age range are not talking about enough, and I want to change that today. Business development companies, known as BDCs, are publicly traded entities that lend money to small and mid-sized businesses. They are required by law to distribute the vast majority of their income to shareholders. And in a high interest rate environment where companies are borrowing at elevated rates, BDCs have been generating distributions that are genuinely compelling. Here is the strategic overlay specific to this economy. The current administration's focus on domestic manufacturing and small business growth means there is a significant and growing pipeline of companies seeking capital for expansion, equipment, and working capital. BDCs are positioned to serve that demand. They charge floating rates in many cases, which means as interest rates move, their income adjusts accordingly. And the best-managed BDCs have demonstrated the ability to maintain or grow their distributions across multiple economic cycles. The risk I want you to understand clearly is credit risk. These are loans to smaller companies. Not all of them will perform perfectly. The key is to select BDCs with experienced management teams, diversified loan portfolios across multiple industries, and conservative loan-to-value ratios. You want to see that the management team has navigated at least one full credit cycle. That is the filter. When you apply that filter, the universe narrows to a manageable set of options that can deliver monthly income in the 8 to 10% range from distributions alone. In a world where your savings account still cannot beat inflation meaningfully, that matters. Asset number 7, energy royalty and midstream income assets. The energy landscape in this political moment is quite specific. Domestic production is being encouraged. Liquefied natural gas exports are being prioritized. The regulatory environment for pipelines and midstream infrastructure has become more favorable. And the reshoring of manufacturing creates domestic industrial demand for energy that is not going away regardless of what happens globally. Midstream energy companies, those that transport, store, and process oil and gas rather than explore and drill for it, operate on fee-based models. They get paid for volumes moved through their infrastructure. They are not primarily betting on the price of oil. They are betting on the volume of activity in the domestic energy sector. And that volume, given current policy direction, has strong support. Many of these companies, particularly those structured as master limited partnerships or corporations that have converted from that structure, pay monthly or quarterly distributions that have been remarkably consistent. Some have paid and grown distributions for over a decade. The infrastructure they own represents physical assets that are difficult to replicate and essential to economic activity. In an inflationary environment, assets that own physical infrastructure with pricing power embedded in their contracts are particularly valuable. The tolls these companies charge are often tied to inflation indices. So as prices rise, their income rises. And as their income rises, your distribution grows. That is the entire playbook for Asset 7. Now, let us step back and look at this complete picture together. Because the goal here is not just to hand you a list. It is to give you a framework for thinking about how these 7 assets work together as a system. Notice what we have built across these 7 categories. We have safety and liquidity in short-duration treasuries. We have domestic policy tailwinds in industrial dividend stocks and energy midstream. We have real asset backing in REITs and midstream infrastructure. We have credit income in corporate bonds and BDCs. And we have income enhancement from existing holdings through covered calls. When you build across all 7 categories in proportions that match your risk tolerance and time horizon, something important happens. The income streams are not correlated. They do not all rise and fall together based on one variable. A trade war escalation might pressure some corporate bonds but benefit domestic industrial stocks. A rate cut might compress Treasury yields but boost REIT valuations. The diversification is not just across assets. It is across the economic variables that drive those assets. That is the architecture of a monthly income portfolio that actually holds up. Let me be direct about that. Building this takes time. You do not build all 7 income streams simultaneously in month 1. You start with the layer that makes sense for your current position. If you have capital sitting in a savings account, earning nothing meaningful, you start with Treasury instruments and build from there. If you already have a stock portfolio, you look at whether covered calls can be layered on top. If you have retirement accounts, BDCs and dividend stocks may fit well within that structure. The sequence matters, the patience matters, and the understanding of what you own and why matters more than anything else. Now, I want to address something that has probably been in the back of your mind throughout this entire video: the political risk. What happens if the trade policy shifts? What happens if tariffs get negotiated away? What happens if a different administration takes a different direction in 2 years? My friend, this is the right question, and it is one that most financial content creators avoid because it is complicated. Here is my honest answer. No monthly income strategy should be entirely dependent on a single political administration's agenda remaining static. The assets I have described today are chosen because they have income-generating characteristics that predate this administration and will outlast it. Dividend-paying companies, infrastructure assets, bond ladders, treasury instruments, these have generated income across Republican and Democratic administrations alike, across low-rate and high-rate environments, across periods of trade openness and trade restriction. What the current environment does is tilt certain tailwinds in favor of specific sectors: domestic industrials, energy infrastructure, logistics. You tilt toward those tailwinds intelligently without becoming fully dependent on them. That is the distinction between positioning and overexposure. Think about that. The investor who puts everything into domestic manufacturing stocks because tariffs favor them today is not investing. They are speculating on policy permanence. The investor who overweights domestic industrials as a portion of a diversified income portfolio because current conditions support that thesis is making a rational, adjustable bet. Those are different postures. One of them survives policy changes. One of them does not. Stop for a moment and ask yourself which posture your current financial life reflects. Because most people, when they are honest with themselves, realize they have more exposure to a single variable than they thought. Whether that variable is their employer, a single stock, a single real estate market, or yes, a single political agenda. Concentration is always the hidden risk. The monthly income approach I have laid out today is fundamentally a concentration reduction strategy as much as it is an income generation strategy. Every new income stream you add is a reduction in your dependence on any single source. And that reduction in dependence is, at its core, what financial security actually means. Not a number in an account, not a yield percentage. The ability to absorb a shock without your life changing catastrophically. That is what we are building here. Before we continue, a quick update. The Command Center is now available for purchase. It's a beginner-friendly 12-month personal finance Google Sheets system designed to help you organize your budget, net worth, cash flow, savings, debt, investing habits, and long-term goals in one calm financial command center. It doesn't just show your numbers, it calculates exactly how much of your wealth is currently idle versus active, so you can make clearer decisions with less guesswork. And for the best overall value, I recommend the Trip to Wealth Complete system, your 12-month roadmap to total financial clarity. It bundles the Command Center with 2 practical ebooks covering mindset, investing strategy, and long-term money organization. The Command Center is live now at the link in the description. Before I close this out, I want to give you one actionable step that you can take in the next 48 hours that will move you forward regardless of where you are starting from. Pull up your current financial picture. every account, every asset, every income source, and write down next to each one a single word. What is the variable that most directly drives whether this income or value continues? For your job, that variable is probably your employer's health or your industry's demand. For a savings account, it is interest rates. For a single stock, it is that company's earnings. For a rental property, it is your local real estate market. Once you have that list, you will immediately see where your concentration lives, and you will have your personal roadmap for which of the 7 assets we discussed today deserves your attention first. Not based on what sounds exciting, based on what actually reduces your most significant vulnerability. That is diagnostic investing. That is how a strategist approaches this question rather than a salesperson. My friend, if you have stayed with me through this entire video, you now have more clarity on monthly income investing in this current economic environment than 90% of people your age who are asking the same questions. Not because this information is secret, but because most people are never willing to sit with the complexity long enough to actually understand it. You did that today. That matters. The economy will continue to shift. Policy will evolve. Markets will surprise everyone at some point. But the framework we have built together today does not depend on any single outcome being correct. It depends on your ability to think clearly, diversify intelligently, and build income streams that are durable across conditions. That is the edge. Now, here is my question for you. Right now, are you an income builder who is actively working on multiple income streams, or are you still an income seeker who is looking for the right moment to start? One word. Drop it below. Builder or seeker? I read every single comment and I want to know exactly where you are so I can make sure the content I create next serves you directly. If this video gave you clarity, share it with one person in your life who is asking the same questions about money and this economy. Not because it helps the channel, though it does, but because clarity about this specific topic in this specific moment is genuinely rare, and the people you care about deserve to have it too. Take care of your income. It will take care of everything else.